I mean, again, back to that big problem you just talked about. You have your bogey. I don't know what it is these days, but 6.5%, 7% for a lot of funds like yours, perhaps. How do you not just allocate so much of the portfolio to equities, given you're never going to get there in this current interest rate environment otherwise?
Yeah, exactly. I think that's the problem for us. And if you look at our portfolio, I don't think anyone's really 60-40 anymore. But if you think about it, we're targeting 65% growth strategies and 35% diversified. That kind of sounds like 60-40, right? Except for the 35% in diversified isn't necessarily all bonds and tips anymore. And the 60% equities is not all straight equities anymore. There's other types of growth strategies in there. So I think for us, we're moving into more active strategies, and we're trying to get extra yield where we can. A lot of esoteric strategies out there we still don't have access to. So there's places for opportunity, but the cost of doing so is much higher. And I think that you really need the right team in place to make sure you know how to execute on those. I mean, if you look back to 1900, 60-40 up until 2020 pretty much got you to your bogey. But going forward, not only will that not get you there, it'll get you negative real returns.
Hey, Phil, is infrastructure going to be interesting for equities at this point? Looking at some of the the pure plays like United Rental, about a 2-month high today, but how much is not already priced in by the market, even as it's been a long time for this bill to actually get in front of the Senate?
Yeah, Carl, good question. Not as much as you would think on the infrastructure side. And I think the other piece is, okay, is infrastructure going to cause an increase in supply of treasuries? And will we see that? Actually, no. We think that treasury issuance next year is going to be about $1 trillion less than it was this year. So think about that for a second, right? So you can get infrastructure spending and less treasury supply. That's a really good story. Again, going back to financial conditions. Carl, I'd say the biggest thing that we're watching to validate are the jobs reports. The Fed is making a big bet on labor slack. We're making a big bet that inflation is transitory because of the influx of labor supply that's about to hit, and we get a cue on this Friday with the labor report. I think that's the biggest thing to watch: the initial jobless claims numbers and the labor report for signs that the economy is reopening, labor supply is coming back, and that you won't see a persistent rise in inflation.
Shepard Smith here. Thanks for watching CNBC on YouTube.